This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Bonds extend to sell-off as Bill Ackman says he's short 30-year treasuries. Meanwhile, the BOJ steps in with unscheduled bond buying for the second time this week. The Bank of England decides the BOE is expected to boost rates again today, with the market and economists split on whether it's a quarter or a half-point hike. Plus, tech heavyweights Apple and Amazon take center stage today. But first, we'll assess a slew of earnings out of Europe, including SocGen and Adidas. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. You know, Kriti, usually when there's a bond market sell-off in the U.S., when it gets handed over to Asia in the early hours of Europe, it usually eases. That's not what we're seeing today. That sell-off has continued.
Yeah, a really interesting dynamic playing in the stock and bond market. Let me walk you through it while I recover from the fact that you called it Adidas and not Adidas. We'll get to that in a moment. S&P futures taking a little bit of a hit this morning, down about 0.4%. If you are to look at NASDAQ futures, a little extra pain in your recent winners, down about 0.5%. So again, the sell-off continues. Danny and I are going to be talking about positioning throughout the next hour. Essentially, are we due for some sort of pullback when it comes to the broader index? And was that Fitch downgrade really just the catalyst of something that was kind of already in the works for a time that seasonally is meant to be kind of a pullback anyway? So we're going to really dive into that topic. But for now, what you need to know is red on the screen when it comes to the futures dynamic. But again, let's come back to the bond market. That point that Danny was just making, the 10-year yield, 4.14 here, already seeing a move higher of about 7 basis points. What's interesting is that you're not seeing that on the front end of the curve. A little bit more stability when it comes to the 2-year yield. Of course, we know that is going to be the note that is tied to the hip of the Federal Reserve. But nevertheless, this is the note that you want to keep an eye on, especially off what we hear from the Bank of England shortly in just a few hours, because that read-through is going to be crucial. Essentially, one of the stickiest pieces of inflation, or countries dealing with inflation around the world, and what they have to say in terms of their strategy of how to tackle it. So really keep an eye on that 10-year yield, which brings me to another story of two central banks, if we will. Danny, we've been talking a lot about what the trade is when it comes to the Japanese yen. Do we just use it for hedging? Does it really tie to the BOJ, which, by the way, has intervened in the market a second time here? Well, Danny, you know I've also had my eye on the super peso and, of course, the emerging markets, the Mexican peso, the Brazilian real as well. So I decided to bring our carry trade to the front and center. The Mexican peso versus the Japanese yen, which right now is kind of doing the exact opposite it's been doing for the past couple of months here. So essentially that carry trade on the back foot this morning, down by about 1.7%, essentially on the idea that even Brazil, which is looking to essentially guarantee another 50 basis points, in Mexico, which may follow that lead, isn't necessarily having as much success as perhaps they thought they would.
All right, she's getting exotic with the currency pairs. I love it, Kriti. I'm a little bit more basic here because the sell-off is accelerating in European equities. We've gotten some bad earnings, Infineon being one of them, LSE being another. But overall, the sentiment is dour for equities for a second day, not necessarily just earnings driven. It does seem to be the global sentiment this morning. European stocks down about 1% on the headline index. FTSE 100, that's the underperformer today, down 1.4%. Some of the metal companies getting hit hard. Iron ore dropping as much as 4% this morning, back below $100. And Kriti, I did want to just point out that move away from duration, that sell-off, it's really taken a global move. The 30-year yield in the UK is what's moving the most, not as much as we're seeing in the US, but still a move nonetheless, 5.5 basis points. If you look at the front end or even in the belly of the curve in the UK, you're not seeing that much of a move, despite the fact we have that BOE decision. Kriti, not only is it interesting from a macroeconomic point of view, as you were pointing out, with sticky inflation, but just because of this bond market. We've seen before the UK bond market bully the entirety of the bond market and bully treasuries. If we get a surprise to the upside, if we get more hawkish speak, it could certainly make a difference with the treasury market too.
Yeah, a lot to digest there, and I think that's really we're going to see a lot more of the volatility. To me, what's going to be interesting is the dynamic between the stock and bond market when you're kind of seeing a sell-off in both this morning, Danny. Of course, the move, what's really started this whole thing, came down to Fitch ratings downgrade of U.S. government credit, put a renewed focus on the nation's debt trajectory. Richard Francis, Fitch's co-head of America's sovereign ratings, well, he was on Bloomberg television yesterday speaking about the action.
AA plus is the second highest rating we have. It's not a low rating. It's not, it's still a very high rating. It just we're just saying that we do not think that the underlying fiscal story and the governance is compatible with AAA anymore.
Joining us now is Bloomberg's Valerie Teitel. Valerie, we've seen a lot of maybe pushback, I want to say, about this ratings downgrade, not just from the likes of Janet Yellen, but also a lot of folks on Wall Street, even Jamie Dimon, saying it doesn't really make a ton of sense. Walk us through just the take and the kind of the day two fallout of what we've heard.
Well, it seems like maybe on day two, Critty, people are thinking that maybe Fitch said something right. We did hear from both former U.S. Treasury secretaries, both Paulson and Geithner, kind of commenting that they agree on Fitch's warning. Paulson said that our fiscal trajectory is concerning. And then we also heard from Geithner. He said, you want to move the system to act before it's too late and too hard to fix. So both of them kind of urging some action on the trajectory of spending of the United States government. But let's see if that kind of pressure makes its way to politicians.
It's a perfect storm because you have this concern about the debt. Again, not just Fitch's downgrade, but in terms of this Treasury supply coming to market. And it does seem like at a time where people are now looking at duration and saying, OK, here's a clear mispricing.
Definitely. I mean, the last few days, what we've seen in the long end, this steepening move that we've seen, I think has caught a lot off guard. Long end treasuries, the 30-year yield has moved 25 basis points this week. We're just 15 basis points away from cycle highs that we saw last year. And we had Bill Ackman, of course, throwing his hat into the ring, offering his commentary. He was out on Twitter, on X, shall I say, saying that he is short the 30-year treasury. He expects more increases of long end supply on the way, saying that there are many times in history where the bond market reprices the long end of a curve in the matter of weeks, and it seems like now is one of those times. That's why we are short the 30-year treasury in size.
Yeah, Dario Perkins from TS Lombard responding to that, also saying we don't even need inflation at 3%. We just need something that's a little bit more persistent. Valerie, tell me what that means, this duration sell-off we've seen for this global bond market, because the BOJ stepped in again this morning.
They did step into today to intervene again. Another 5 basis point move seems to be what triggered them. But a lot of this is what's going on is really not good for the bond market. The BOJ lifting that anchor, the last anchor of keeping yields lower. We're also seeing the U.S. economy running very well. Government spending hold up. All these pressures going on in the bond market really causing this steepening to extend. And Danny, we could get another kicker this afternoon in just a matter of hours. If we do get a surprise announcement from the Bank of England that they are ramping up the pace of QT, that could really add to this bear steepening move, and it could maybe get ugly.
Bloomberg's Valerie Teitel walking us through those moves. These next few weeks are going to get really interesting. And of course, for more on that, let's bring in the worsening global profile of safe debt. We need that conversation. Bloomberg cross-asset reporter Denitsa Sikova is all over it. Denitsa, talk to us about exactly what Valerie was just mentioning. If we're positioned for a lot of this pressure, where do we go from here? What do traders do?
Yeah, I mean, so we kind of took a step back and we wanted to see how does that downgrade look with the historical trend. And it's kind of what we've seen for a very long time. It's something we've seen in corporate debt. It's something we've seen in sovereign debt. Obviously, the U.S. Sovereign market is huge, but there are only 9 countries left with a AAA rating from all 3 agencies, which kind of 2 decades ago was a very common status to have across developed economies. Of course, we're kind of seeing a very similar trend in corporates. Like it was very common, it was a lot more common for companies to have that AAA status. For example, in 1980, there were like 60 companies that had that gold-plated status, and now there are actually 2 that have it from all 3 agencies. It's Microsoft and Johnson & Johnson. So there is like a wider trend that raises the questions of first, is AA kind of becoming the new AAA, or is it more that people, and especially investors who are like rating sensitive, will go into those small markets? I have preference for them. Of course, it's important that this is a long trend. Canada, UK have been downgraded, so a lot of funds are not so sensitive and have adjusted their constraints.
It's interesting, Denitsa, how this conversation, it's not anything new, but it's been enough to upset the apple cart. It's enough to have markets sell off. I mean, you look at just the bad timing of this. Just let's focus on the sell side. Mike Wilson saying he was wrong in the past few days about a more steep sell-off. Citi raising their year-end target. Stolfus at OPCO raising to a street high for the S&P year-end target. How poorly positioned is this market right now if things were to turn more ugly?
Yeah, I mean, people have been warning about it for a very long time. Things moved very fast, positioning moved extremely fast. If we look at stock buying, there is a Deutsche Bank metric saying it was the fastest pace similar to the release of the vaccine in December 2020. Another big trend that kind of was overpowering in 2022 was people were hedged, they were defensively positioned. Now there was so little demand for hedging, people were moving away from cash. So it kind of made sense with things moving fast, with little protection on the downside. The big winners of the last few weeks, unprofitable tech and all those kind of riskier corners, saw some of the sharpest and biggest losses this year. So it's kind of a reversal of the sharp, risky moves we saw in the last couple of weeks and months.
Yeah, I mean, again, it's going to be fascinating to see if this sell-off worsens today, if you do get some of that positioning unwind even further. Denitsa, thanks so much. That's Denitsa Tetsakova from our cross-asset team. Okay, here in the UK, as Valerie was mentioning, as we all have been mentioning, a BOE rate decision is going to be coming in about 2 hours. Now, another increase, which is what's expected, would make it the bank's 14th consecutive rate hike. Standing outside the Bank of England on Threadneedle Street is our Bloomberg UK correspondent, Lizzie Burden. Lizzie, this market, it seems firmly split on whether we go 25 or 50.
That's exactly right, Danny. And part of the reason, the big reason, is of course that cooler than expected June inflation reading. Traders off the back of that pared back their bets for where they see UK rates peaking. They now see 5.75% or thereabouts. But we had this Bloomberg scoop revealing that a majority of the Chancellor's economic advisors, some of whom, of course, are ex-Bank of England, are worried about the risk that the bank over-tightens. It'll be interesting to see whether the bank, in its updated forecast today, factors in a recession for the UK economy. That's the reason that some on the MPC wouldn't want to go for another jumbo hike, doubling down on the last meeting. You can tell from everything I've just told you, Danny, it's very confused going into this meeting, and that's why Bloomberg Economics reckons you might get a three-way split today. 3 going for 50, 5 going for 25, and 1 going for a hold. It would be, I think, the first three-way split since December, so one to watch out for there. And in terms of the language around the decision, probably likely to echo the ECB and the Fed in the sense of leaving the door open to a hike or a hold at the next meeting, all depending on the data.
Well, this is why exciting. Literally either way they go, 25 or 50, it will be a surprise. Lizzie, thank you so much. Lizzie Burden, outside the Bank of England. Stay tuned for our special coverage of that central bank decision at 7 a.m. Eastern Time. And later this hour, we're going to get more insight on the BOE. We'll be speaking with HSBC senior economist Liz Martins. But first, up next, we got to talk tech because giants Apple and Amazon are getting ready to take the spotlight. We'll give you a preview of those results. Plus, a look at some of the big earnings stories on Europe happening here. That includes SocGen, Infineon, and, as Kriti would say, Adidas? I can't even remember how you're supposed to say it anymore. We'll get to the bottom of it next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Earnings season, we are in the thick of it. Qualcomm, they gave a weak forecast. Then we got Apple and Amazon coming out today after the U.S. market closed. A lot to dig through. Joining us to do that is Matt Bloxson of Bloomberg Intelligence. Matt, let's start with Qualcomm. What were your key takeaways there?
Yeah, so as you said, like a weak forecast for the coming quarter. So they guided to 8.1 to 8.9 billion of revenue. So the midpoint about 8.5, consensus at 8.8. So, potentially a miss on the cards there. And the reason behind that is weak outlook in China. and weak outlook for the smartphone market. And those two things kind of intersect, but together China and smartphones both about 60% of their revenue. Now they are shifting and diversifying into areas like automotive chips and Internet of Things chips, and they even talked about AI on their call too, but those things are not yet big enough to really compensate for those sluggish trends they're seeing in China on smartphones. So yeah, kind of a disappointing print essentially for Qualcomm there.
Well, Matt, speaking of those smartphones, let's talk about Apple and even Amazon reporting after the bell. Is it still all about the iPhone?
Yeah, I think it is obviously that the iPhone 15 is due out in the kind of final months of this year. So I think there's some optimism around what they'll say about volume there. But I guess maybe on the back of that Qualcomm print, perhaps people's optimism will be kind of pared back a little bit. And on Amazon, obviously most of their revenue comes from online retail. But what's in focus there is the cloud business, which generates most of the profit, and some questions there about their AI strategy for that business. So I think that's where the focus will really be, and whether we see a significant slowdown in growth. People are looking for about 10% year-on-year growth at the cloud business from 15% last quarter.
Okay, Matt, thank you very much. A lot to cover. The two heavy hitters from the U.S. market. Matt Bloxham from our Bloomberg intelligence team. Now, coming up, we're going to get back to the European earnings story. We had SocGen beating estimates in its first report under the new CEO. That's next. This is Bloomberg.
We had a very, very strong third quarter, and now based on the mega trends we are very much benefiting from, be it electrification, be it renewables, be it IoT or data center, we could continue to believe also in a strong finishing quarter, another 4 billion. So therefore we are reconfirming all our formally communicated targets for the year.
That was the Infineon Technology CFO speaking to me and Mark Cudmore earlier in programming. Now, he might be confident there, but shares of Infineon are falling the most in 2 years. The company's fourth quarter outlook raised concerns about profitability for the chipmaker. Joining us now is Bloomberg's Germany correspondent Oliver Crook. Oliver, talk us through these results. What's got the market so concerned?
Yeah, he may be positive. The market certainly taking a very different view of that this morning, where it's sort of session highs at -8%. And really, it's a question of profitability. It's a question of margins. They came in a little softer this quarter, and really they're looking even softer going forward. And on top of that, they're spending big to open a new fab over in Malaysia. That's 5 billion euros. Investors perhaps a little concerned that that might be overstretching a little bit. So we had the biggest drop since the pandemic today. But remember, if you held this stock from the lows of the pandemic, you've more than tripled your money. This is, overall, so let's not lose sight of that fact. We've got the CEO now on the earnings call saying that he's very bullish on China and China autos, which is probably reflecting why they're opening that fab there in Malaysia.
Let's get to another German company reporting today as well. A solid set of results coming from Adidas. Walk us through those numbers.
Yeah, they've been bouncing around. They opened a bit higher, then lower and up again. And really, it comes down to volatility and inventory. Inventory is still a massive problem over at Adidas. They've got 5.5 billion euros worth of that. Came in a little bit higher than what they had been anticipating. And really, when you look at the sales, it's a little bit concerning. The good part is China. Sales were up 16% in the second quarter. The bad news, North America down 16%, and EMEA basically dead flat. And EMEA and the United States and North America are the biggest markets. Now, I know what you really want to hear about, which is Yeezy. They managed to move 400 million euros worth of Yeezy inventory in the second quarter. This was seen as sort of a stranded asset potentially for a lot of investors, so they've managed to sell some of that. And we're learning now from the earnings call how much of it they're going to give to charity. From the second quarter sales, 110 million euros of that is going to go to charities.
Okay. And just seeing some lines out from Adidas, too, the CEO speaking in a media call saying that they won't try to sell Yeezy products under a different name, and Yeezy likely to include cheaper products.
And the reason for that is they can't get the wheat. It's interwoven into the sneaker, so they can't actually get it out. They tried, they looked at it, they couldn't do it.
I'm trying to think, you could change the Y into something else. I don't know. I'll have to think about that one. It'd be too expensive anyway. Oliver, thank you so much. Bloomberg's Oliver Crook in Berlin. So that's the German corporate story. Let's talk about the French corporate story because SocGen beat estimates, most estimates I should say, even though key revenue lines weakened in a lackluster trading environment. Let's get over to Bloomberg's Caroline Conan on this. Caroline, it's the first results under a new CEO. What did they deliver?
Actually, SocGen positively surprised this morning because analysts were expecting a very lackluster quarter, and it was not as bad as expected. So, for example, if you look at equities trading, revenue fell 6% compared to like 3% for the French rival BNP Paribas that reported last week, for example. But that was a beat compared to estimates. Also in fixed income, revenues fell there 18%. That's in line with BNP Paribas, but also better than estimates. So overall, revenues was down in most divisions, but above estimates, so not as bad as expected. The new CEO, Krupa, actually said in the analyst call just now that inflation, he thinks inflation is not yet under control, but in theory, the changes in monetary policy should support trading going forward. One of the units that was actually a drag also was the French retail, because in France, banks have a hard time to pass on the increase in interest rates because a lot of the time mortgages have rates that are fixed and the new loans are capped. So also very difficult when it comes to a French retail.
Caroline, thank you very much for that. SocGen shares up 2.4%. Coming up, we'll talk about the BOE with Liz Martins, HSBC senior economist. All of that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Treasuries extended a sell-off as Bill Ackman says he's making sizable bets on declines for 30-year U.S. Treasuries. Meanwhile, the BOJ steps in with an unscheduled bond buying for a second time this week. Across the country, the world, if you will, the Bank of England decides the BOE is expected to boost rates again today, with the market and economists split on whether it's a quarter or half-point hike. Plus, of course, tech earnings continue. Heavyweights Apple and Amazon take center stage later today. But first, we'll assess a slew of earnings coming out of Europe, including SocGen and Adidas. I'm Kriti Gupta in New York with Danny Berger in London. Danny, so many cross currents here, but it really does feel like a day two of really what we saw yesterday, that downgrade spurring a lot of repositioning.
It did. Also, the Treasury, with the amount that they're going to have to borrow, the issuance that will come from that. We heard Bill Ackman saying, of course, short the 30-year yield. It's the most obvious trade in markets right now. If supply is going to increase and if inflation stays more stubborn than expected, it does mean that globally bonds just aren't behaving as any sort of ballast in the storm. It's stocks and bonds selling off. FX markets a little bit volatile too. Here's what we're seeing in European stocks. There are a lot of earnings. We had some big disappointments. We had a big disappointment from Infineon, a big disappointment from LSE. Some of those large cap moves are really what's weighing on us. Again, plus that just overall macro story of gloom. Stock 600, it's off of its lows, but still down 0.9%. FTSE 100, that's underperforming even more. You get a lot of global facing companies here. So if it's a global sell-off, it makes sense that the FTSE 100 might be leading some of those declines, down 1.33%. We're also going to get a BOE decision, Kriti. You just mentioned this. And the sell-off we're seeing in bonds right now in the UK and gilts isn't about that. It's about this global sell-off we're seeing, and that is evidenced by the fact it's duration that's selling off, much like the U.S. 30-year yields, Kriti, higher by 5.5 basis points.
Yeah, well, the sentiment you're seeing in Europe is really just flooding right here into the States, both on the stock front and the bond front. We'll start with the equity story. S&P futures down about 0.3%. What I will say is they are paring some of their losses. In just the last 30 minutes, we've been on television. You've already seen a little bit of a reversal when it comes to futures trading. 45.23 on those contracts, you should really see that's pulling back pretty crucially from that 4,600 level. A lot of the pain, though, is isolated or concentrated. I'm going to get my words right. Concentrated today, I should say, in a lot of the winners we've seen, which really brings us to big tech. NASDAQ 100 futures down about 0.4%. So again, seeing a little bit of a day two pullback. Danny, if this is the start of that mini correction Jay Woods told us on our show earlier this week, then this kind of is starting to look a little familiar with what we see seasonally in terms of the equity market. The bond market, a similar story. And again, I would say at the whim of the BOE today, 414 on the 10-year yield, higher by 7 basis points already. But look, you go to the front end of the curve, you're not seeing that same move. So really keep an eye on what this 10-year yield does as soon as we hear from the Bank of England. I want to dirt out a bit, Danny, and really talk again about central banks around the world, because in the absence of a really clear trade in terms of whether or not we're going to hit a soft landing or a hard landing, there is a carry trade that has been afloat. The Mexican peso, the super peso, if you will, against the Japanese yen, and the continued weakness you've seen there. Well, today that trade is flipped on its head, down about 1.6% in favor of the Japanese yen. Danny, this is really important because, of course, we know the BOJ has tried again to step into the bond market for a second time. How long will that strength last in the yen?
And here's the risk, Critty, is that amid all of that volatility, we could get something unexpected from the BOE that will just increase it. Let's focus in on that, because expectations at the moment for the Bank of England is that they'll hike rates again. But the thing we're not so sure about is whether it will be 25 or 50 basis points. It's a subject that both markets and economists are divided on right now. Let's bring in Liz Martin, senior economist at HSBC. Liz, I want to get your take. What is your expectation, 25 or 50?
So our forecast is for the 50 basis points, same as last time. And that's because, yes, the winds around the world are blowing in a more dovish direction. But, you know, the UK, the Bank of England, is facing a particularly acute inflation problem. You know, core inflation 6.9%, private sector pay growth nearly 8%. So the forecast that we put in place last month was for 50 basis points. Now, as we've, you know, moved away from the decision last month, the data have come in more dovish. So we had a downside surprise in inflation, we had some soft PMIs, and I think the risks to that 50 have certainly increased. But, you know, talking to clients and investors through the last couple of weeks, no one's got very strong conviction on this. Could it be 25? Of course. Could it be 50? Yes. You know, the Bank of England has surprised us in the past, so we'll find out in a couple of hours.
Yeah, I mean, let's hope it's 25 or 50, because I feel like it's just going to be absolute mayhem, if not one of those, Liz. On 50, if I can just play devil's advocate, I mean, why rush? Why go at it jumbo? Is there really that big of a difference between going at it 25 or 50 again when the latest prints have showed some relief?
Yeah, well, I think that people will be making that argument. There's another argument which says, you know, if you're going to do 50 anyway, why not do it quickly, and then you can stop sooner, especially if we think other central banks around the world are done with their journeys. Does the Bank of England want to be the one that's still raising rates towards the end of the year and into next year? But regarding that downside surprise on inflation, we certainly hope that it is the start of a continuing trend where UK inflation falls back. But we had a downside surprise in UK inflation in January. It was then followed by 4 massive upside surprises, which led to the BOE having to be more hawkish. So I think good news that we did have that lower number in June, but we're not counting our chickens that that's inflation done and dusted now for the UK.
Well, Liz, talk to us about the role that quantitative tightening plays here. The BOE was one of the early movers on that front. How is that going? How effective is it? Walk us through that side of the story.
Yeah, so we're coming up to the first anniversary of active sales. The Bank of England said, you know, they were going to do £80 billion a year. They've done that. And actually, I don't think it's made a tremendous amount of difference to anything. Of course, the BOE was we were the global guinea pig for this. Other central banks have done passive quantitative tightening, so not reinvesting the proceeds of bonds once they mature. But the BOE was the first to come out and say, well, we're going to actually sell into the market. And lots of people were worried about that, particularly, I think, in conjunction with high levels of supply of new debt from the UK government. But actually, I'm not sure we can point to a huge additional impact, either in negative terms, in terms of raising the cost of borrowing, or in terms of actually making a difference to reducing inflation. But we have come up to the year point, and the Bank of England will need to update us on what they're planning to do. We're expecting them to comment not today, but actually next month in September. And actually, they're talking about raising the pace of quantitative tightening. And that probably tells you quite a lot. If they're able to raise it without worrying that that's going to slow down the economy too much, then that tells you that it's had a relatively small impact overall.
And listen, factor in the currency story for us as well, because I'm still waiting for some material currency weakness, given that the BOE really hasn't been able to crack down on inflation to the extent that some of its peers has. I'm looking at 126 on the cable rate. How does that factor into all of this?
I think, if we just think about the August meeting relative to the last one, actually sterling is up on a trade weighted basis since then, and that will reduce inflation a little bit. But of course, that's not the BOE's kind of main priority. They're more worried about the kind of underlying supply demand factors in place. So I don't think the currency is probably going to be a big part of the picture today, except that it contributes to a slightly lower inflation outlook from here, and we do expect them to be revising down their inflation forecast, not just because of the currency, but partly because of that.
Liz, I need more weakness in the pound, so when Kriti comes to visit me here in London, breakfast will be on her. So away from selfish matters, when it comes to the composition of the MPC, we do have a difference this time. We have Megan Green now replacing the most dovish of members, Silvana Tenreiro. Megan Green, definitely more hawkish. How does that change the composition and the split of decisions that we're likely to see today?
Well, look, the reality is there's been two uber doves on the MPC, Silvana Tenreiro and Swati Dhingra. They've been voting for no change in interest rates for quite some months. I think if they had their way, bank rate would still be at 3%. And the reality is that, they make for an interesting debate, but they haven't been leading policy. So the loss of Tenreiro and replacement with Megan Green probably doesn't make a huge difference to the direction, but it makes the committee slightly more hawkish on balance. But generally speaking, what's driving the majority decision? It's not what Silvana Tenreiro or Megan Green thinks, it's what the governor and the kind of core internal members think. But we don't know too much about how Megan Green thinks about the UK economy. We've heard a few bits and pieces from her. My best guess today is that she will vote with the pack, and we will get probably an 8-1 vote, with the 8 going for a hike, whether it's 25 or 50, and the 1, Swati Dhingra, sticking with her vote for no change. But, we will see.
Okay, so perhaps the composition not really changing things too much. What about the politics, Liz? Of course, the Bank of England is independent, but we've seen in the past how politics affects their decisions. If we are heading into what's likely an election year for the UK, if we have, for example, Jeremy Hunt's economic advisors concerned that they're going to tighten too much and do damage to the economy, what difference does that mean for the BOE moving forward?
Well, I can see why one might make the argument that the government won't want rates to go too high, because that's, making us all have to pay more on our mortgages and slowing the economy down, and nobody likes any of that. On the other hand, nobody enjoys persistent spiraling inflation, and I actually think the government, what the government said in the past indicates that it is very focused on that. Jeremy Hunt kind of said to Andrew Bailey, you need to do what it takes to get inflation back down, because, a recession is one thing, it's not nice. High mortgage rates are not pretty either, but, the government is a big victim of high inflation as well. A quarter of our national debt is linked to inflation. The public finances are under pressure because of inflation. So I think the government wants the BOE to do what it thinks is necessary to get inflation back down, and then hopefully rates can come down at some point after that. But it's an ugly economic picture going into the election, I think, kind of either way, really.
Liz, what I love about having you on our show is that you can talk about any central bank around the world. So let's broaden this out a little bit. When you talk about the BOE and the stickiness you were seeing in the UK specifically, is there a read-through towards the Federal Reserve, towards the ECB? Is Christine Lagarde or Chair Powell really watching that closely? What's happening with Andrew Bailey's England?
I think all of the central banks are all watching each other, right? And we're all grappling with broadly the same problems. However, I think, particularly Chair Powell will look at the UK and think we've got a considerably worse problem in terms of core inflation, a couple of percentage points higher in the UK and no decisive downturn. So I think the UK and the US economies are in different positions, and I think we'd be more optimistic about inflation coming down a bit more quickly in the US perhaps than in the UK. But for the Eurozone, I think it's very similar. And actually, you could make the argument that the Eurozone is at an earlier stage in its journey, you know, just starting to see wages pick up, whereas the UK, hopefully, we're kind of more at a turning point. So very similar issues, I think, for the UK and the Eurozone. I think the debate's going to be the same. When we heard from the ECB last week, the question was, well, are they going to go in September now or not? And the same question, I think, you know, possibly will apply to the BOE this afternoon, depending on what we hear from the committee. So, you know, similar problems, but I guess varying degrees.
Is the ECB, though, in terms of what's different for them, in terms of their uniqueness, they're more early on in the stage of the rate hiking cycle, but given the economic data, is their headroom less than the Fed with stronger American data, maybe even less than the BOE? Does the ECB, again, just have a smaller runway on where they can take rate hikes, even if inflation would seem to dictate that they should go further?
Yeah, well, look, we're only forecasting one further interest rate rise from the ECB in September, and they indicated that it might not even be that. You know, potentially they could have stopped. What we saw last week could be the last one. But as you say, they've got some growth problems. I think, you know, a lot of, say, Germany's problems relate to the manufacturing sector, which is really not where the inflationary problems lie. You know, globally, if we look where we've got inflationary pressures, it's much more on the service side. And, you know, I think from the PMIs today, you see that service sector demand is holding up more strongly. So they do have a bit more strength in that sector. But I agree with you, you know, slowing economy, it will be hard for them. And as I say, only one more hike on our forecasts.
HSBC's Liz Martin's walking us through the central bank stories around the world. We thank you, as always, for joining us. And of course, we're going to come back to the story that seems to be moving the markets for 2 days now, that Fitch downgrade from, of course, AAA to AA+. That moving the markets yesterday. Day 2 is today. We're going to dive into exactly what the reasoning was. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Fitch Ratings' decision to strip the U.S. of its AAA credit ranking highlights the booming deficits at the heart of the bear case for Treasuries. Bloomberg spoke to Richard Francis, the company's co-head of America's sovereign ratings, about its reasoning behind the decision.
We did, right after the resolution of the debt ceiling with the Fiscal Responsibility Act, mind you, just 2 or 3 days ahead of the X date when they could possibly not make some kind of payments on its obligations. We indicated then that we would resolve the rating watch in the 3rd quarter, and we wanted to take our time. We wanted to opine upon the impact of the Fiscal Responsibility Act itself on the deficits and on the debt level. We wanted to update our own numbers and look at where we think the fiscal trajectory and the debt is going, and we wanted to just take stock of the actual debt ceiling debate and its resolution as well. So we wanted to take our time and give a thoughtful analysis to both the fiscal picture and on the kind of governance issues and as well.
It's worth talking a little bit about the criteria you set out about a year ago, about what it would take to get to a downgrade, because some of the things have changed in terms of the picture. Let's start with the rise in debt to GDP ratio. The significant and sustained rise did not be so significant or sustained. So why is that not factored in here in terms of the decision made more recently?
Well, the debt level has been rising quite significantly. If you look at before the great financial crisis in 2007, debt to GDP was at below 60%. Now it's 113%. The 113% is almost 3 times higher than the AAA median, and it's more than twice as high as the AA median. So you've had a sustained deterioration over the years. Yes, debt to GDP peaked during the pandemic at 120% and has come down. And that's because, of inflation and high nominal GDP growth, and also the withdrawal of the stimulus, especially last year. But now we're seeing debt levels starting to rise again, and we do not see them stabilizing. We just see them continuing to rise in the next 3 years, and probably more over the medium term. And that 113% is still 13 percentage points higher than where it was before the pandemic. So you've had quite a deterioration on the fiscal and debt side.
Richard Francis there of Fitch Ratings talking to us about that downgrade, which, Danny, has spurred a sell-off both in the stock and the bond market over these last 48 hours. I think it's really important to keep in mind, though, that even though there has been a lot of pushback on exactly what Fitch is saying, they also have a point, which might be something that the bond market is pricing in.
Yeah, I would also say, Critty, that this goes beyond what Fitch has done. I mean, it's summer market. There's more jitters. And at the same time, the Treasury has been talking about the issuance that they need to do, the supply that's likely to hit markets. All of that feeding into why we're seeing a sell-off in duration. Ackman laid it out for why he wants to short the 30-year yield and says about an uptick in inflation. We might not even need an uptick in inflation for more things to sell off, Critty. Perhaps just more inflation volatility.
Yeah, a lot of cross currents here from both the fiscal and the monetary side. We're going to, of course, keep you posted throughout Bloomberg Television and radio. Coming up on the show, a look at some of the market moving events to watch throughout the day, including earnings from Apple and Amazon. This is Bloomberg.
I'm actually feeling very positive, I'll say bullish about the environment in this market. There are a lot of changes moving in the right direction. You hear some comments questioning some of them, but I think overall the momentum is very much moving in the right direction.
That was the London Stock Exchange Group CEO David Schwimmer speaking to us earlier. He thinks things are going to come back at some point, but at the moment, it was their first half results that sent shares lower, down by 1.6%. The concern was a small EBITDA miss, but a miss nonetheless. So that first half growth faltering, that's what's moving things here. AB InBev, one of the bright stories to come out today, the beer maker, really strong results, especially in LATAM. It's clear they've gotten away from some of the Budweiser controversy that's been plaguing them. It also just shows that Heineken results in retrospect were pretty weak, considering that AB InBev was able to turn it around. BMW also gave a lower cash flow guidance. They had pre-warned earlier in the week. We got the details today. The market's still not happy about that, down 2%. And Lufthansa, again, it's a story about costs and also their debt load. So those shares, Critty, falling some 5%.
Yeah, and I would argue a similar story when it comes to the states, because we did get a ton of earnings here stateside, Danny, overnight, which aren't necessarily being well received by the market. I want to walk you through PayPal to kick it off with. They're talking a lot about transaction margins really missing. And get this, Danny, analysts not happy about it. Shares down about 8.4% here, prompting, get this, 8 price target cuts across Wall Street. So seeing a lot of pain in that stock. Again, it all comes down to margins, which is a similar story for Qualcomm as well. Of course, the chip maker that is well known for being an Apple supply chain, setting off a wave of red across all the chip makers, basically falling on handset weakness, some of the slump that's already baked into the market, and of course getting downgrades again from Wall Street. Qualcomm shares also down about 8.7%. But Danny, all the focus, and I think what could really change the tune of the entire market, what we hear from Apple and Amazon after the bell. Apple shares down about 0.3%, but a little bit more optimism when it comes to Amazon, higher by 0.5%.
Yeah, again, this market doesn't like tech at the moment, be that for some of the earnings, be it for the higher yields. As you say, could Apple, could Amazon turn that around? Apple really has been the darling of this market. There is certainly an amount of earnings volatility priced in. Just looking at it, the one-day implied move on options is about 3.5% for Apple. It's not too big considering we have seen bigger moves. But yeah, Critty, again, this could definitely shape the direction of tech for the next quarter.
And of course, we know that a lot of people have been waiting for that mini correction, some sort of 5% pullback. Of course, that all would start, in theory, from big tech. That does it for early edition. Surveillance is ahead. John and Lisa are going to take you through an all-star lineup. This is Bloomberg.